Strategic planning is the process an organization uses to set its direction and make decisions that help achieve its mission, vision, and goals. The approach we'll discuss focuses on doing this efficiently and effectively, providing a framework for sustainable growth and competitive advantage. It starts with a clear mission and specific objectives, which are measurable and realistic goals set within a timeline. For example, a company in engineering, procurement, and construction might aim to deliver high-quality infrastructure at competitive prices, aiming for significant growth in revenue and earnings over 5 years. Next, a position audit helps leadership understand the current state of the business by reviewing progress toward goals, assessing financial performance, managing working capital effectively, and ensuring the company can handle its debt while delivering returns to shareholders. This approach gives a structured way to align actions with long-term success. When conducting a business position audit, it's important to look closely at various aspects such as employee performance management, whether key management team members are meeting their objectives, and the effectiveness of the organization's information systems. We need to identify any gaps in critical management information and evaluate how efficient the sales processes are, including the strength of the order book and contract pipeline. We also consider future business development opportunities and review financial performance alongside the suitability of the financial strategy to support growth plans. The audit will inevitably generate a list of actions needed to capitalize on opportunities and address threats, and these actions must be translated into a well-managed execution plan. Essentially, a business position audit provides a clear, systematic snapshot of where the business stands today, highlighting its strengths and weaknesses as a foundation for strategic planning. One key tool in this process is the corporate appraisal, often called SWOT analysis, which evaluates internal factors like strengths and weaknesses, as well as external factors such as opportunities and threats. Strengths refer to internal advantages like product capabilities, competitive edges such as better distribution or technology, unique selling points, and resources including people with the right expertise and assets. Understanding these elements helps build a solid base for developing effective long-term strategies. When looking at a business, it's important to identify weaknesses such as disadvantages in the product or service, gaps in capabilities, competitive weaknesses, financial constraints like high debt, poor processes or systems, missing accreditations, and limitations in IT or communications. On the other hand, opportunities come from market developments, competitors' vulnerabilities, new geographic or export options, seasonal trends, current styles, and niche or specialist market segments. Threats can include political factors, legislative changes like taxes, environmental pressures, technological advances that reduce demand, new competitors with better offers, reduced consumer demand due to economic downturns, and shifts in distribution models like e-commerce replacing traditional retail. To approach opportunities effectively, it helps to align new efforts with the organization's existing strengths. For instance, a chicken farm might expand into fast food outlets in growing markets where demand for affordable fast food is rising, leveraging existing expertise rather than moving into unrelated fields. Similarly, an airline could grow by entering international air cargo services, which leverages its current operations rather than starting something entirely new. This strategy often lowers development time and costs while increasing chances of success. Using existing assets, like aircraft, can help generate additional business and increase cash flow. Often, threats to an organization can be managed by leveraging its strengths. Weaknesses, on the other hand, can sometimes be turned into opportunities, but it's important to minimize these weaknesses to avoid potential threats. Conducting an environmental analysis is crucial for developing a strategic plan. One common method is the PESTLE approach, which looks at political, economic, social, technological, and legal factors. Political risks include issues like government instability or unpaid obligations. Economic risks involve interest rates, exchange rates, and inflation. Social risks cover things like unrest, labor disputes, and changes in consumer behavior. Technological risks might come from new technologies replacing existing ones, such as Wi-Fi replacing cable internet or e-commerce impacting physical retail stores. Legal risks come from changes in laws, for example, changes in tax legislation that affect business cash flow. Competitor analysis is also valuable but often overlooked. It evaluates the strengths and weaknesses of both current and potential competitors, helping identify market opportunities and threats. This analysis also refines marketing strategies across price, product, promotion, and distribution. Additionally, it guides corporate strategy decisions about acquisitions, disposals, joint ventures, and growth opportunities. Typically, it involves creating detailed profiles of major competitors, covering their background, ownership, governance, financial position, growth methods, products, brand strength, patents, and marketing strategies. This comprehensive approach helps a company stay competitive and adapt effectively in the market. When analyzing competitors, it's important to consider various factors such as their advertising themes, promotional strategies, market segments, shares, growth rates, distribution channels, joint ventures, geographic reach, pricing, and discount strategies. Understanding the management team, their strengths, and leadership style is also key. Knowing each competitor's corporate strategy, including their mission, objectives, growth plans, and any acquisition or disposal activity, provides valuable insight. To respond to opportunities or threats, businesses have several strategic options: organic growth, acquisitions or mergers, joint ventures, franchising or licensing, exporting, divestment, maintaining the status quo, withdrawing from the market, or consolidating operations. Organic growth focuses on expanding the current business through increased output or sales, or starting new ventures with proper planning and management. In contrast, mergers and acquisitions involve combining or purchasing businesses to gain market control or synergy. Acquisitions usually involve buying a company using cash, shares, or debt, giving the buyer control. Mergers bring two companies together under agreed terms like share exchanges or financing. Joint ventures involve collaboration between parties sharing equity, profits, and losses in a specific project, often through a separate entity. Divestment is the process of selling off assets, the reverse of investing. Choosing to do nothing means maintaining the current strategy. Finally, leaving a market can be a strategic move. For example, if an airline withdraws from poorly performing routes to focus resources on more profitable ones, potentially improving overall business success. Each of these options can be explored further depending on the specific situation. Rationalization as a strategic option often means restructuring or turning around an underperforming business, transforming it from cash negative to cash generative. When restructuring is necessary, the plan must be clearly defined with both financial and operational details, and included in the budget as well as the organization's longer-term 5 to 10-year strategic plan. Performance should then be managed by regularly reviewing financial results and any key performance indicators or KPIs set. Evaluating strategic options involves looking at both their qualitative pros and cons and their quantitative impact on the company's financial forecasts. Once investment decisions are made, performance measurement becomes critical, focusing on delivering shareholder returns, managing debt responsibly, and maintaining financial viability. This requires solid processes and controls across the organization. A key recommendation is that all businesses create and update a 5 to 10-year strategic plan each year. This helps the organization stay prepared for sustainable growth and respond wisely to opportunities or threats. The planning cycle includes revisiting the mission, reviewing past objectives, conducting environmental and internal audits, appraising options, and setting measurable targets linked to KPIs, which are then assigned to key leaders to drive accountability and results.